Joining us from New York this morning is Alec Young. He is an international equity strategist at Standard & Poor's, here to talk about what is going on with the stock market and the economy. Mr. Young, I've showed our viewers, talked about this headline with our viewers all morning. It's from the Wall Street Journal last week. Stocks hit post-crisis high, and it says that the Dow Jones Industrial Average closed above 12,000 on Tuesday for the first time since June 2008. How did the stock market get to this position after the crisis?
Well, we had a variety of factors come into play to drive this the tremendous rally that began in March of 2009 when the S&P 500, which is a slightly broader gauge of the U.S. stock market than the Dow, hit about 666. The S&P is currently in the 1,300 zone, and similarly the Dow got down to about 7,000, and the Dow, as you mentioned, is now up north of 12,000. We've had several drivers. The first thing is the global recession really forced companies to get very lean and mean, and that really hurt Main Street as companies were laying people off. There just wasn't enough demand during the recession to have that many people on the payrolls. And as we've come out of the recession, demand has started to pick up, but companies have stayed fairly lean. And so that's really improved their profitability. They're relying on increasing productivity per worker, doing more with less. They're relying on technology to help them stay more and more productive and produce more and more goods without necessarily hiring more people. So we have a combination of an improving global economy, improving demand, but very low costs, and that's leading profit margins to be very healthy, and that's led to a dramatic rebound in corporate profits. And one of the biggest drivers of the stock market is what's going on with corporate profits. Another big driver is that the revenues, the sales for American multinational companies are increasingly global. Close to half of revenues now for the S&P 500 are coming from overseas, and we've seen much more economic resilience in a lot of the key big emerging markets like China and India than we have here at home. And so that's another thing that's really helped the profit recovery for the large American companies.
Which companies have profits, are seeing profits? What kind of companies? We heard the president yesterday use the figure $2 trillion, that companies are sitting on $2 trillion. Is that accurate?
Yeah, that's a fairly accurate measure of the cash that's on the balance sheet of the S&P 500 companies. The figure will vary periodically, but as a broad ballpark, there are record amounts of cash on the corporate balance sheets, and we're really seeing it across sectors in terms of that big cash infusion. In terms of the profit recovery, it really has been across sectors. You tend to see a little bit more momentum in terms of earnings recoveries during economic recoveries in cyclical areas that tend to be more leveraged to what's happening in the economy. Areas like consumer discretionary, so that's going to include things like entertainment, hotels, retailers. Those things tend to get hurt very hard in recessions because we don't necessarily need to spend money there. It's more discretionary, something like a restaurant. But then when we feel more confident, we start to spend more. So there's been a big profit recovery in places like consumer discretionary. We've also seen a big recovery in technology. As I mentioned, that's increasingly global space, benefiting from emerging market momentum, benefiting from companies' desires to do more with less and making those key technology investments. But really, even when we look at more defensive areas that are counter-cyclical that tend to hold up better during recessions, like utilities, more dependable, slower, steadier businesses, those companies have also seen nice recoveries. Consumer staples, so that would be things like household products, paper towels, shampoo, razor blades, those companies, while they weren't hit as hard in the recession because they tend to be a little bit more counter-cyclical and durable to economic downturns, have also seen their profits recover. So when you see the kind of earnings momentum that we have in the last couple of years, it tends to be fairly broad-based. You wouldn't see this kind of momentum if it was just limited to one or two sectors.
You talked about this a little bit before, but somebody tweeted in earlier from our Twitter audience asking the question of who is buying these companies' products to give them these large profit margins? I mean, how is it that we're in a so-called jobless recovery, yet we're seeing these profits?
Well, there's a couple of factors there. Number one, a lot of the sales are business to business. So companies like Cisco Systems or IBM, really they're selling to other companies. So the general improvement in corporate health is helping those corporate sales, which are a big piece of the pie. Secondly, we're increasingly more global. So it's the S&P 500, which is an American index, or the Dow Jones, which is an American index. But if we look at the revenues of these companies, whether it's an AT&T or a JP Morgan or a Procter & Gamble or a Hewlett Packard, they're really global, very global. Coca-Cola, some companies like Coke, you're looking at well over half their profits coming from overseas, something like 3/4 of their revenues. Now, Coke is more global than most, but even across the board, companies like American Express, 3M, Caterpillar, and these companies are all in the Dow as well as the S&P 500. Really a very global footprint, and while we saw a slight hiccup in emerging market growth in 2008, 2009, it really was just a slowdown from a very high rate, and we've seen growth then rebound in 2010. So we've seen continued momentum there. So there's a lot of increasing consumerism in the emerging markets, increasing incomes, a growing middle class. Those people are starting for the first time to buy products that we've been buying our entire lives. So that's been another thing that's driven the situation. More domestically, we've also seen a bit of a stratification. So the high-end retailers are doing extremely well as the wealthy continue to spend, and the low-end are doing extremely well because you're seeing a lot of people in the working and middle classes more cost-conscious. So hopefully that gives you some sense of where the spending is coming from.
I want to read a tweet here from a viewer who says, these stock market analysts and the press simply look at the stock charts and make up a reason why it went up or down. So that sort of gets at the question of what does an international equity strategist do?
Well, I actually have a global mandate here at S&P, so I work with our team on the U.S. and I also cover the international markets. A strategist will take input from analysts. At S&P Equity Research, we're the biggest independent research provider in the world. We have about 50 analysts in the U.S. We also have analysts in Europe and London, and also in Asia, in Singapore, and other Asian offices. And they're giving us bottom-up feedback on the companies that they cover in the 10 economic sectors that make up the stock market. So those 10 sectors would be financials, technology, energy, materials, industrials, consumer staples, consumer discretionary, telecom, and utilities. And so those are the buckets that our analysts are following, and they're giving us data based on a bottom-up basis, their analysis of companies. And then we're factoring in macroeconomic factors. So we're talking to our analysts, or our economists around the world, and getting a sense of what the momentum is in the European economy, the Chinese economy, Canadian economy, U.S. economy. We're also factoring in technical factors where we have people that are analyzing chart patterns of sectors and stocks. And so we're rolling all of that together, and we're coming up with more top-down recommendations. So in an economic recovery, we want to be overweighting areas that tend to have more leverage to the improving economic fundamentals. So that means industrials, technology, and materials, which are the mining companies. So that's an area where a strategist will use more of a top-down macro approach to try and add value for clients.
Alec Young is our guest. He's up in New York with Standard & Poor's. We're talking about the stock market and the economy. Edgecombe, Maine. Jim on the Democratic line. You're first. Go ahead.
Yes, good morning, sir. There's a couple things that you neglected to bring out. I've been owning stocks since 1969. Now, first of all, you never bring anything about hedge fund managers, and the hedge fund managers who manipulate stocks and have been manipulating stocks for years were the main reason why so many of these stocks went into the toilet. I'll give you two examples, sir. First of all, let's take one of the high flyers nowadays, is Apple Computer, which I have owned for years. Prior to the crash, Apple was selling at $200 a share. They dropped it down, the hedge fund boys, down to $80 a share. Now it's up to $350-something a share. Okay, Apple has never, in the last 10 years, missed a quarter. They've never had a period of time in which they hadn't had a good product base. But the hedge fund managers, sir, threw it in the toilet. To another stock, General Electric, that was selling at $30-something a share, is now down like 16 or 17. It should have been thrown in the toilet because their financial division, which charges 28% for credit cards and stuff like that, had destroyed the stock.
Okay, Jim. Alec Young.
Sure. Well, first of all, we need to clarify some of these off-the-cuff remarks that I'm getting here. The U.S. stock market is worth about $30 trillion. Hedge funds globally control less than $2 trillion. So the notion that hedge funds control the U.S. stock market is inaccurate. The markets tend to be very efficient. So when news comes out, it's quickly priced into stock prices. If someone were trying to manipulate the market and push it up artificially, someone else would have an incentive to come in and sell those stocks short or bet that they would go down because they would see an opportunity to make money by doing that. So that really leads to a highly efficient market. And the reason that that Apple and GE collapsed along with the rest of the market in late 2007 and throughout 2008 until early 2009 was because of real fears of a global recession. We had a global recession. We had a major credit crunch, and there was a lot of uncertainty about what it would do to even the strongest companies' profit outlooks, and therefore the sell-off was perfectly rational. Coming out of that, we've seen Apple defy the skeptics and continue to be a first-class company, and that's led to the recovery in the share price. GE has had some successes, but also some issues in terms of coming out of the recession and their profit recovery. So you haven't seen quite the recovery in GE stock prices you have in Apple's. But the notion that hedge fund managers are behind the scenes manipulating global capital markets, I think, is an exaggeration. There are certainly case-by-case instances where they may be a factor. Not that there's anything wrong with that. Hedge funds have every right to be in the market, buying and selling like everyone else, as long as there's no inside information or illegality going on. The participation of hedge funds makes markets more liquid, more efficient. When you want to go and buy a stock, the fact that there are institutional players in the market buying and selling that stock all day long leads to better pricing for the individual investor.
Rick, an independent in Newington, Connecticut. Morning.
Well, good morning. When you explained the reason for the stock market increasing, I'm glad that you were candid and you talked about global sales. Look, I only need about a minute here, but I was in the trenches in the 90s, fighting on the side of the majority of Americans opposing most favored trading status for China, for GATT, which was 7 feet high. Nobody had read it. And the NAFTA, which never really increased the standard of living in Mexico, but did many deleterious things. The fact of the matter is that this whole thing is very ironic, because more than half the households in the United States now hold stocks. And corporations, we created or allowed U.S. corporations, and then we allowed them to go overseas and take our industry and jobs with them. And the thing is that it's very ironic that the creation of these corporations may be the final blow for Americans and Americans' standard of living, and that's the reason that that all the income, we're becoming less and less relevant as more and more people around the world become consumers, and we move our jobs away. And when you combine that with the incredible flood of illegal cheap labor into the United States uncontrolled, we are headed for serious problems in the United States.
Okay, that's Rick, an independent in Connecticut. We'll go to Brian, a Republican in Lynchburg, Virginia. Good morning.
Yes, good morning. I have two questions for Mr. Young. The first question is, Mr. Young, as you described the stock market, it's had a big run-up over the last 18 months or so, but it seems to me that that's come about with relatively light trading volume, so that it seems like it's come without the broad participation of a lot of the public. And I wonder if that's true. And my second question is, how in the world is it that the stock market keeps on going like gangbusters while the government is spending us into unprecedented debt? So that isn't this really just setting us up for just an even larger crash than the one that happened in September of 2008?
Mr. Young.
Okay, well, two very good questions. On the first, in terms of public participation, the caller's absolutely right. We've seen big institutional bullishness on stocks, people that that run mutual funds, and a lot of those institutions, I should mention, are managing money for retail investors. When you buy in your 401k into a mutual fund, that's an institutional investor that's then buying stocks on your behalf. So just because most of the interest in the stock market rally so far has been institutional doesn't mean that the retail public doesn't have some skin in that game. But it is true that given the brutality of the 2008 bear market, where the S&P 500 fell 38% just in 2008 alone, investors were understandably a little gun-shy about getting back into the market. We've started to see that shift in December of last year and into this year. We're starting to see money flowing back into U.S. stock funds. International stock funds continued to gather money throughout 2009, 2010. But in terms of the U.S. stock market, it's true that retail or individual fund flows into U.S. stock funds have lagged up until very recently. But frankly, that tends to happen in these cycles. The people that get paid to watch the market every day are usually quicker to notice a potential turn, and so they're quicker to get back in or out. And you generally don't see the public getting back in and very excited about stocks in a big way until you get a lot closer to the 7th or 8th inning. And that's why I think financial advisors will tell people the best thing to do when it comes to investing is to come up with a plan with your advisor that makes sense for you and your long-term goals, and leave it alone and just continue to add to it out of every paycheck. Don't try and time the market, because the history shows that when the public tries to do that, it tends to not work out that well for them. As for your second question, another very good question about how can the stock market be doing so well when the government, continues to run up these huge deficits as far as the eye can see. Part of that is the whole notion of Keynesian economics, where when the economy is very depressed, as it certainly was a couple of years ago, you really need the government in there stimulating activity, because the private sector is very gun-shy, very reticent to do that, and so the government has to step in and kind of kickstart the economy. And because of the financial crisis, that threw off even more financial obligations that the government had to step up to do. And to their credit, they were successful in kind of keeping us out of the abyss and getting this nascent recovery going. But at this point, now that the recovery is starting to be increasingly self-sustainable, although we do want to see a lot more progress on the job front and the housing front, we want to start to see the government pull back. And with corporations now with record amounts of cash, we're starting to want to see increasing capital expenditures on their part. We're starting to see that. As far as the hiring is concerned, I think they're ready to do it, but they want to be a little bit more confident that that demand is going to be there. They know that there's demand outside the U.S. for their products, but in terms of the American demand, I think executives want to see a little bit more evidence that this recovery is for real, and we think that before too long you're going to start to see improving momentum in the job market. Having said that, given that we're sitting at about 9% unemployment, we're not looking for that to tumble to 5%, in the next few months. It's going to be a slow climb out, but we are expecting the economy to be adding a couple 100,000 jobs a month, up from the recent average of about only 100,000 jobs by the end of this year. So, we should hopefully we've seen the worst with jobs and housing, and we're starting to see some improvements there.
Alec Young, Bill Beatty tweets in this. Could you please explain briefly the Standard & Poor's warning on debt to U.S. Congress?
Right. Well, at Standard & Poor's, we have a lot of different businesses. I work in the equity research business, where we really focus on analyzing the stock market for clients. Our ratings business, which is what the gentleman is alluding to, is an entirely separate division. And for compliance reasons, they keep us completely separated for legal reasons. And I really don't comment publicly on anything that's going on the ratings side. So I'm afraid I'm going to have to pass on that question.
Sure, no problem. Here's the Washington Post headline this morning. Credit card debt up first time in 2 years. Is that the kind of confidence, the kind of headline that Wall Street wants to spend when it comes to, that Wall Street wants to see when it comes to consumer spending?
Absolutely. What we've seen, and we needed to see some paring back by consumers in terms of their credit card spending over the last couple of years. We've seen a steady decline in the amount of money that people are owing to their credit card companies. But given the fact that We do need the economy to start to pick up. And executives need the confidence and demand to start hiring. Consumers need to start picking up the spending a little bit. You prefer to see that happening out of savings and not so much borrowing, but a modest little uptick in credit card usage, I think, given the overall context, is probably a healthy thing, as long as the spending doesn't become too debt-driven. Ultimately, most of all of our spending ought to be coming out of our pockets, not out of somebody else's.
Jeremy, a Democrat in Claremont, New Hampshire. Good morning.
Hi, Alex. I'm a business management major and an Obama supporter, and my question is, how much has Obama's policies influenced the stock market gain, and where do you need Obama and his team to go in the future?
Well, I think, recently we just had a major step towards the center from the president, where he agreed in the wake of the November elections in December to extend the Bush tax cuts, which was something that the Wall Street community was definitely in favor of. The recovery, in the fourth quarter of last year was simply not strong enough to sustain a major tax increase, which effectively would have been what would have happened if we'd allowed all those tax cuts to expire. We really needed that extra shot in the arm for the economy. I think the president recognized that. He moved to the center. He made a deal with the Republicans. He extended it. So I think Wall Street is a much bigger fan of Obama today than they would have been if you had asked them, the night before the election, when there was a lot of uncertainty about what was going to be happening with tax policy. So that's certainly a step in the right direction, and I think we want to continue to see a centrist tone. Nobody expects President Obama to be the next Ronald Reagan, but certainly we would like to see him at least meeting with business leaders, hearing what their concerns are, and really more of a consultative, moderate view from the president. And I'm pleased to say that increasingly that's what we're seeing, and I think that's certainly part of what's fueled the last leg of the bull market on Wall Street.
Chi-Chi's 55 comment on Twitter is, businesses laid off millions. Now businesses say no demand for their product. There won't ever be demand as millions don't have jobs. James, an independent in Ohio, go ahead.
All right. I'd like to tell Mr. Young that he's sitting on one of the largest bubbles that this country has ever known. And Wall Street has went completely out of control because of the money that they put into Wall Street and kept the money off of Main Street until the money gets back to Main Street. That when that bubble busts, I'm 82 years old. I'm a retired Chevrolet dealer, and I know that we're in real desperate trouble with foreign automobiles and the housing and the material that is coming from foreign countries. I'll get off the line and listen to you.
James, are you still there?
Yes.
So you see a bubble right now in our economy?
There's one of the biggest bubbles on Wall Street that there's ever been. I'm 82 years old.
All right. Alec Young, is there a bubble on Wall Street?
Well, that's a pretty open-ended question because, it was a very general commentary. So generally when people talk about bubbles, they'll narrow it down a little bit, maybe a bubble in the gold market or
Sure.
a bubble in the stock market or the housing market.
So do you see one? Is there a specific bubble that's happening on Wall Street?
No, to answer the question in a fairly direct way, is there a bubble on Wall Street? I'll take that to mean in the stock market. Absolutely not. If we look at the valuations on the S&P 500, the largest 500 companies in the U.S. approximately, we're trading at slightly below the long-term average, even though interest rates and inflation are very low, and that tends to lead to a higher multiple, a higher valuation in the market. So just on a valuation basis, there's really no signs of a bubble on Wall Street, as opposed to in 2000 after the tech run up, when we were trading at 30 times earnings, and clearly there were some real unsustainable excesses going on. We saw that in the housing market a couple of years ago, but there's really nothing on that scale in the stock market. And one thing that you tend to see before a bubble bursts, to have a bubble, you need broad-based ownership. You need everybody to own something. Everyone's talking about it. And as we talked about earlier, the public really hasn't embraced the stock market yet. So it's almost impossible to have a bubble in an asset class that the average person really wants nothing to do with.
Thomas, Democratic line in Burlington, Iowa.
Yeah, I just had a couple questions for him. I wanted to know when the bubble hit and all the stocks went down and everything went down, I was just wondering what regulations were put forth to stop that again from happening. Obviously, nothing has happened, and if you know of any, can you tell everybody about them so we know what's going on. I just don't believe that anything's going to ever change, and I believe what the 82-year-old just called in, said there's a bubble, and look out, people. Thank you.
Well, it doesn't sound like I'm probably going to change your mind. Again, another very broad-based question. I'm not a regulatory expert. I mean, one thing that has been put in place since the credit bubble burst and the subsequent severe recession is an incredible amount of financial regulation put in place to make sure that there are safeguards so that something like that can't happen. I mean, at its core, you had mortgage origination, which was a huge business, a huge consumer business, where people were going out and trying to convince homeowners to refinance their mortgages, switch into different mortgage products so that those mortgages could be pooled and resold to investors. And that was a huge consumer business, and it was completely unregulated. It was unprecedented to have that big of a situation where Wall Street was working with Main Street on a product, and there was absolutely no regulation. Clearly, that was a mistake, and that's been completely addressed. So I doubt we're going to see another housing credit-driven type of debacle. But generally speaking, what happens is you'll have a problem. The regulators will fix that problem, and then the next problem will have nothing to do with that. Will come from a different angle, and these things are very difficult to foresee. But at this point, given where the various asset classes are trading, the only thing that really looks like it offers very little long-term value to us are long-term treasuries. So long-term U.S. government bonds, yielding about 3.6% on 10-year yields. Just really not enough to get us very excited to recommend those to clients. So I think if you wanted to talk about a bubble, and that might even be too strong of a word, but if you wanted to talk about an asset class that really didn't look like it had very good prospects, I think long-term U.S. government bonds would fit that category more so than talking about a stock market bubble or a gold bubble or a real estate bubble in the current environment.
This is the headline this morning in the New York Times business section. A seer on banks raises a furor over bonds. It says that Meredith Whitney, 41, finds herself in the news media and criticized by colleagues for predicting a calamity in municipal bonds. And it says that Ms. Whitney is also drawing scrutiny from Washington, where a congressional panel will meet on Wednesday to examine the turmoil in the muni bond market, including whether Ms. Whitney's call has fed into the volatility and allowed some investors to profit unfairly. Ms. Whitney will not be at this hearing, citing scheduling conflicts. But what's going on here, Mr. Young?
Well, I mean, I'm not a municipal bond expert. I know that Meredith Whitney, a very well-respected analyst because of some prescient calls that she made on financial stocks before the bubble burst a couple of years ago, tends to garner quite a bit of attention when she speaks out about something. And she made some comments on 60 Minutes about the increased risk in the municipal bond market. And I think given the increasing state and federal deficits, and the fact that revenues, because of the recession, had been falling, clearly it's an above average time for risk in municipal bonds, which is an asset class that historically has been extremely safe with something like a 0.4% long-term default rate. And she's basically predicting that is going to tick up because of the financial stress. Again, I'm not enough of a municipal expert to really give you a very sentient critique of her analysis. I'll just say that she probably knows a lot more about it than I do, and we certainly have people on the ratings side here that are experts on that area, but unfortunately I'm not one of them.
Sure, we'll go to Jim in Tennessee on the Republican line. You're next.
Hello?
Morning.
What's the matter with the stock market on day-by-day purchases of people that these companies buys up a lot of stock, and they run the stock market up, and then at the end of the day they sell it off. And that's the way they was doing the oil. You remember they stopped that because of quick market buying and so forth.
Okay, Jim, let's leave it there. Mr. Young, is that how it works?
I'm not sure I really heard a question in there, so. Well,
he sort of laid out how he sees the Wall Street working. Is that accurate?
No, I think if you're asking me, do I think Wall Street is a huge pump and dump scheme? No.
All right, Annapolis, Tom, Independent Line.
Hi, good morning. Great conversation. Before I ask my question, just an observation about the previous discussion of globalization, that there's just this inherent conflict between us wanting to maintain our American standard of living with high wages versus corporate profits from lower wages overseas that then can feed those markets and create consumers for our goods. So it's just an intrinsic conflict. But I wanted your guest to talk about abuses and distortions in the market. Everything, with the systematic dismantling over the years of the Glass-Steagall protections, then you had, the municipal bond craze or the M&A merger craze in the 80s because companies were allowed to deduct the interest that they had to pay for acquiring assets, or these derivatives that we now see have been the cause of the latest problem, or, insurance companies, or I should say accounting companies, being able to evaluate companies that they themselves had invested in without disclosing that. What about the need to eliminate these distortions of the free market?
Again, I'm not a regulator. I'm going to probably leave it at that.
Mr. Young, I want to get your reaction to what AP is reporting about Wall Street this morning. Stocks are mixed in early trading after a round of disappointing earning reports. It says that home builder Beazer Homes USA said that new orders declined. Avon Products stock fell 6% after it said its earnings fell 15% last quarter. Why are earning reports, or how are earning reports received on Wall Street, and does company information have more impact on Wall Street numbers and pricing of stocks than, say, what is happening in Washington?
I think both things can be influential. Certainly the macroeconomic news out of Washington, for example, the decision to extend the Bush tax cuts had a very favorable impact on stocks. But obviously, a major driver for stocks is, how the companies are doing. Do people want to buy their products? Are they making money? So the earnings season is always, a very busy one on Wall Street, and it's a big driver. Overall, today we did have a few misses, but they've very much been the exception of the rule. We've had about 2/3 of the companies in the S&P 500 beat their earnings expectations so far. Right now we're getting fourth quarter 2010 corporate earnings results from companies, and 2/3 have exceeded those. In addition, for a long time, profits growth was really driven by cost cutting and productivity gains. What we're seeing now is revenues starting to pick up steam, running about 8% up over a year ago, which is very healthy. A lot of that is driven by international momentum, especially in emerging markets. But there's also, whenever you see S&P 500 revenues up 8%, there's certainly a domestic component there. So overall, the earnings season has been better than expected, and it's finally starting to be driven by revenue growth, which is always something that you want to see.
Real quickly here, AP is also reporting the Obama administration is proposing short-term relief to states saddled with unemployment insurance debt, coupled with a delayed increase in the income level used to tax employers for the aid to the jobless. The administration plans to include the proposal in its budget plan next week. What will be the reaction of Wall Street to that?
I'm not an economist. You're throwing a lot of questions at me, and they're really not in my general area of expertise, so I'm going to have to defer on that.
Okay, we'll go to San Diego. Matt, Democratic Line.
Hi. These latest reports of earnings may be mixed, but they come on the heels of a third quarter that was record-breaking profit for corporations, and apparently they're sitting on more cash than they have had for 100 years or so. So why are they hesitant to hire people?
Because companies are owned by their shareholders, and the mandate that companies have is to maximize their profits. And so they're not going to hire someone in the U.S. for $50 an hour if they can hire someone that they think can get the job done just as well in India for $20 an hour. Capital will seek the highest returns. And as Americans, if we want these jobs to remain in the U.S., we have to move up the learning curve. We have to have more education. Increasingly, the job growth in the U.S. is coming from healthcare, from consulting, from legal, from accounting, from technology innovation, more and more high-end type of stuff, as the emerging markets are starting to dominate the lower-end commoditized manufacturing. So as Americans, we can sit here and complain, why aren't American companies hiring? American companies aren't hiring because they can get a higher return on their dollar somewhere else. When you go out to shop, where do you go to buy your goods? You go to the store where you're going to get the best bang for your buck. Well, companies are doing the exact same thing. And as Americans, if we want jobs, we need to take responsibility for the fact we need to improve our marketability. We need to improve education. That's why investing in education is so important. But I think we need to be a little bit more self-reliant. The job of a company is not to give you your dream job. The job of a company is to make money for the owners of the company. And you want to make sure that you can really add value for that company and give them a real business reason to hire you. And when you can find that blend, that's a perfect marriage. And that's when our system really works best.
We're going to try to get in a few more phone calls here. Don in New Mexico, Independent Line. Don, can you make it quick, please?
Yes. As an antidote to what this man is saying, I suggest they go to a John Cassidy article in the November 29th New Yorker 2010. The article is headlined, "What Good is Wall Street?" He goes on to say, much of what investment bankers do is socially worthless. My comment is this. 2/3 of all trades on Wall Street are high-frequency trades. Many of those high-frequency trades last a duration of 22 seconds. From the time they get in to the time they get out, they're 22 seconds. And what they're taking is just a small fraction, 1 point. Now, if 2/3 of these trades are high frequency, if they're just lasting 22 seconds, tell me what that adds to this economy, since all they're doing is churning.
Mr. Young?
Right. Well, what it adds is liquidity. So when you, as a fund investor, invest into, say, a large cap fund in your 401k, and that manager goes out to buy large cap stocks, and he's buying, an IBM or a GE, the fact that the hedge funds are in there trading around that stock improves the liquidity, and that makes it cheaper for individual investors to invest their money. So, and the other thing to keep in mind is, even though these high-frequency trades do represent a surprisingly large percentage of average daily volume, if you look at most investors are buying and holding for the long term in retirement accounts, and so they're not really featured in the daily trading volume. So the daily trading volume, just capturing people that are buying and selling on any given day. The larger percentage of people that have money in the markets, the larger pool is much, much larger than that. And I don't think the hedge fund presence has really served to distort valuations in the market.
Okay,
the market is going up, but there are fundamental reasons for it.
All right, Mr. Young, a couple more comments. Here's one from someone who tweets in, what's going up? Food and fuel. And this person questions whether or not there's a commodity bubble. Let's go to Patrick, who is in New York on the Republican line. You're our last phone call. Patrick, we really have to make it quick. Go ahead.
Hello, I was just wondering, what role does the Fed have in the stock market rally? The reason why I'm asking is because in 2007...
Patrick, we're going to have to leave it at there and just get an answer from Mr. Young real quickly.
Sure. Well, the Fed's had a big role. Right now, they're really trying to stimulate the economy. They're pulling out all the stops to make the cost of money very cheap, to get people's business activity to increase, to get the economy on the mend. So the Fed always has a big impact on what's going on in the economy and on Wall Street.
And finally, Mr. Young, if I could just ask you real quickly here, because I think we have about 30 seconds or so left. What are you looking for from the market today? What should viewers be looking for?
Well, we tend to recommend people not focus on the market on a very short-term basis, but we have had a very good run in the market, and we had an interest rate increase from China. There's concerns about maybe a slowdown in that very important global economy. We've had a couple of profit warnings, so I wouldn't be surprised to see a little profit taking in the market today. But recommend your investors really keep their eyes on the long term and not worry about what's happening day to day on Wall Street.
And the Wall Street Journal has this headline in the front page: cash buyers lift housing, bargain hunting, boost prices in depressed cities, broader asset rebound spreads. What are you looking at for housing market?
Well, the housing market is really still the Achilles heel for the economy, so it is an area that our economists do expect to lag some real momentum in manufacturing and in other parts of the economy. Having said that, though, we do think that it's in the process of bottoming. So hopefully that article today is a harbinger of things to come.
All right, Alexander Young, international equity strategist with Standard & Poor's, joining us from New York. Thank you, sir, for your time.
Thank you.
And up on Capitol Hill, there are several hearings happening this week. One today at a House Judiciary Subcommittee on C-SPAN 2, live coverage today is about abortion funding. You can go to cspan.org for more information about that. It's around 4 p.m. Eastern Time, live coverage on C-SPAN 2, the House Judiciary Subcommittee on the Constitution. It'll ban abortion funding. Coming up next here on C-SPAN, we want to bring you to the Hudson Institute, where there's a discussion on Egypt, its revolution, and the future. Thanks for watching.